Factor affecting reported profitability. Profitability analysis in financial statement analysis would mean that you will have 2 years financial statements, prior year and current year, and you need to make some comparisons between the gross profit margins or net profit margins or operating margins and how the reported numbers would affect your analysis. So the first thing is that US GAAP and IFRS. US GAAP are the accounting standards that are used in the US, and IFRS are the accounting standard issued by International Accounting Standard Board, used elsewhere in Pakistan, in the Middle East, in entire Europe. So both IFRS and US GAAP, they require financial statements to be prepared on accrual basis. Cash-based accounting is not permitted under both IFRS and US GAAP. Now, what is accrual-based accounting? Accrual-based accounting dictates that transactions are recorded when they occur, not when the cash is paid or when the cash is received. Like, for example, if I have delivered goods or if I have rendered the services to my customers and I have to receive $150,000 for those goods or services, and I haven't yet received the money, but since I have played my part, so this is my revenue and I must record it as my income and the corresponding receivable, right? Similarly, even I haven't received a single dollar, but I have earned it, so it must be reported as an income. This is called the income accrued but not yet received. On the other side, let's say today is 31st of December, and I have taken services of my employees for the whole month, and normally I make salary payments on 5th or 7th of the next month. So that means if this is December 2021, so salary for December would be paid on, let's say, 5th of Jan 2022. Now the point is, since I have taken services from my employees, I have used electricity, gas, and water, but the bills of electricity, gas, and water will be paid next month. Salaries will be paid next month. So at the end of the period, I must book these expenses on accrual basis, even no cash has yet been paid. So I will debit the salary expense and credit the salary payable, debit electricity expense, telephone expense, credit the payables. So you need to accrue these expenses at the end of the month. You need to accrue the income at the end of the period so that cash impact can be removed, because incomes and expenses, they are not determined by the cash receipts or the cash payment. They are considered on accrual basis, and that's what the IFRS US GAAP requires. Exactly, Vikas. So that's the important point, that we need to use the accrual accounting. Cash accounting is not allowed both under IFRS and the US GAAP. Now we are going to discuss some components of your income statement and how they affect the reported profitability. That's the topic for tonight. Cost of goods sold, all of you know, it is one of the largest cost element in any financial statement, whether it's a manufacturer or whether it's a retailer. Cost of goods sold is the single largest impact on your profitability. So companies need to pay a special focus on keeping an eye on its cost of sales. And this can be done by the common size financial statement analysis we discussed in our previous classes. Like we have our last year's number and current year numbers. Dollar versus dollar will be a little misleading. If we convert our numbers into percentages, this would reveal a lot of things. Look at this now. Last year, our cost of goods sold was 93% of sales. If everything has remained the same, our CGS should be almost the same percentage, but it has fallen, which is a good sign apparently. But we need to investigate that this reduction in cost of goods sold is not caused by the compromise on quality, because eventually it will affect the business. So even it is the cost that has the greatest impact. Its reduction is good for the business, but we need to see that the reduction is not caused by some quality compromises. So that's an important point to be noted. Next, we are going to discuss common size financial statement from comparison purposes. Analyzing the trends in expenses. We can do the same concept, the common size financial statement analysis, express your prior year and current year income statement numbers in percentages will reveal a lot of things by comparison. Now, just look at a few things given here. If you compare your sales and commissions last year, it was just 0.07% of your sales. And this year, it is 0.67, quite a significant increase from 0.07 to 0.67. At the same time, look at this. Your freight out was just 0.36% of sales. This time it's 0.89, comparative terms. Same thing, we have the travel from 0.36 to 0.56. So we can compare the trend in expenses, whether they are proportionally increasing or decreasing, and they will reveal a lot of things. So we can see the company's operating expenses increase overall. And in the breakup, we can see that comparatively sales, salaries, freight out, travels, they have now taken up more of your revenue. They are now a larger proportion of your expenses than the previous period. Salaries, commission, etc. So this is how you compare like versus like by converting the numbers into common percentages, and that becomes much easier for us to analyze. Then there are certain types of expenses which are, I'm sure most of you are familiar with, but let's just have a quick overview. Selling expenses will involve selling and marketing expenses, salaries of the sales representatives, rent of the sales department, commissions which are paid as a percentage of sales, traveling expenses linked to sales, advertising, selling department salaries, samples of our product which we give to our employees for customers, they are also considered as a sales expense. Credit and collection cost, the money spent on recovering money from our customers, the eventual bad debts are caused because of sales. Shipping cost, the freight out cost spent to deliver the goods to our customers, all these are classified as selling cost. So these expenses are driven by sales. Some of them are fixed, like sales staff fixed salaries, and others are variable, like commission. Commission is variable dependent upon the percentage of sale. Similarly, the general and administrative expenses, we know what they are, but just need to rediscover the idea. General and admin expenses, they are incurred for a business as a whole. These are the expenses incurred for the general direction of the enterprise. These are what I would say the expenses incurred at the head office. They involve the accounting, legal costs, officers' salaries. When you say officers' salaries, you're talking about the chief executive officer, chief operating officer, chief investment officer, chief accounting officer, insurance of your head office facilities, wages to the head office staff, supplies used in the head office, and of course the office occupancy cost. If the head office building is on rent, so you will find rent here. If it is owned, then Vakas, you will find the depreciation of the head office building, and of course depreciation of the office equipments used in the head office as well. The next major element, major categories of expenses is depreciation. Depreciation, we know, is the systematic allocation of the cost of the asset over its estimated life, and we know how to calculate it. It is calculated by deducting the salvage value or the residual value from the asset's cost and dividing it with the estimated useful life. This is a fairly basic idea you would have studied in your earlier classes. The important point to note here is that the depreciation is a non-cash item. Nonetheless, it could be quite a sizable expense on your income statement. Depreciation can appear both on your operating expenses, and it could also appear as a part of cost of goods sold. Now, why? If the depreciation is on property, plant, and equipment, in that case, it's a product cost. Depreciation of your plant and equipment in the factory is a product cost. It becomes the part of product, eventually becomes the cost of goods sold. But if the depreciation relates to your head office equipments, vehicles, then clearly it is an operating expense. And it could sometimes be a sizable expense, but it involves no cash outflow. Then another major expense you would see on your income statement is the maintenance and repair expense. Primarily, this expense is fixed. Why are we studying all these? Because we will be analyzing these numbers. We will be converting them into percentages, and then we will be making comparison from one period to another. So we need to know what they are, what drives them, which of them are fixed, which of them are variable. Increase or decrease in these can affect the business in the long run. So maintenance and repairs are fixed. Some of them are discretionary. Now, this is something important I will discuss. Let's say our plant manager is given $1 million for upkeep of maintenance and upkeep of machinery. This is totally discretionary. It is up to his decision whether this money should be spent or not. Sometimes this discretionary expense might not be deliberately spent so as to smooth your income. Like in some period when the profits are expected to be low, maybe the plant manager or the plant supervisor, he might be forced not to spend the money on overhauling and repair and maintenance. So don't spend this money this year because the profits are suppressed this year. So this is something you need to be careful, that maintenance discretionary spending could be manipulated to smooth out your income. When the incomes are low, this spending will be deliberately suppressed so as to show higher results. This is not good for the company's earning quality. Earning quality means the profits are just being deliberately manipulated by under and over providing for expenses. Then interest expense, this is something we know. It's a charge against your income for the funds the company has borrowed, whether it could be on the bonds issued or it could be the loan from the banks. Interest is charged on the passage of time. Like you have borrowed $100 million from a bank on long-term basis, and you acquired this loan on 1st of July, and you end up on 31st of December, the year end, and no interest payment has yet been made, but the interest accrued will be for 6 months. So let's say the rate agreed with the bank is 7%, 100 million, 7% will be the interest for the whole year. Since the loan was only due for these 6 months, the passage of time from the loan sanctioning till the end of the balance sheet date, so it's going to be 6 months out of 12. So this is how you charge the interest on the passage of time. A company may have different sources of debt. We would have issued some bonds, we would have issued some debentures, we would have borrowed money from banks on long-term basis. Interest rate could be different. Bonds are at 7%, bank loan is at 12%, debentures might be at 3%. So you might be interested to calculate the effective interest rate. Effective average interest rate, that is the different types of sources of funds we are using. Let me show you. You won't be required to calculate this, but just I'll give you the idea. Now, let's say you have 3 different sources of funding from debt. The interest cost on all these 3 comes out to be 150. Interest on funding 1, 2, and 3 is 150. And the total funds of these, in the numerator, you have the interest expense of these 3 different sources of finance. And in the denominator, we have the total funds, the book value of the funds. Let's say if that happens to be $9 million, let's say. Now this interest cost divided by the funds will give you what you call the average effective interest rate. If it comes out to be 10%, you need to compare this rate with the competing businesses, whether we are paying more overall or less. So this is a concept you should be aware of. Then we have a concept related to amortization. Depreciation is charged for the assets that are tangible, property, plant, and equipment. And amortization, it's kind of depreciation for intangible assets with definite life. Remember, this is the area of your pure financial reporting, CMA Part 1, Section A. Amortization is made for those intangible assets that have definite life. The way we charge depreciation on physical assets, we charge amortization on intangible assets that have definite fixed life. Exactly, patents, copyrights, licenses that have fixed life. We amortize the depreciable base of these intangibles over the life of the assets, right? And then last is income taxes. We know what income taxes are. This is an area that is discussed in much more detail in your CMA Part 1, Section A, External Financial Reporting. The last and the most relevant one for us as financial statement, as analysts, are these three things: changes in accounting principle, change in accounting estimates, change in accounting or any accounting error. Now, what I'm talking about, let's say I have 2 years numbers with me, 2021 and 2022, and I am performing financial statement analysis. If 2021 and 2022 numbers are based on the same estimates, same principles, then this is good for me. My analysis will be meaningful. Because 2021 and 2022, they are based upon the same foundation, same policies, same estimates. So things are much easier for me to compare. But this is not always the case. Things can be sometimes problematic. Like, what if there has been a change in accounting principle? In 2021 and 2022, the revenue recognition standard was changed. 2021 financial statements were prepared under the old revenue recognition standard, and 2022, they are under the new financial reporting standard. If it happens, US GAAP and IFRS require you to report these two numbers on the same basis. So what you have to do, you will have to revise your 2021 financial statements as per the new revenue recognition standard, so that it becomes comparable. So this is an important point to remember. If accounting standards change, then all the numbers reported side by side, maybe I also have the numbers related to 2020. Standards require me that I will also revise the prior year financial statement on new standard basis. So 2020, 2021, and 2022, they will all be prepared retrospectively based upon the new revenue recognition standard. Ms. Maham, you're absolutely right. It's called retrospective treatment. So any new accounting standard would require all the prior year financial statement which are given on comparatives to be based on the new standards. So as an analyst, this is good for me. If I get financial statements of this type, even prepared in the previous period under the old standard, they will have to be revised as per the new standard. So for me, the numbers are on the similar basis. So for me, the comparison will be easier. Comparison will be effective because the financial statements are on the same footing, are on the same standard. So if there is a change in accounting principle, there is retrospective treatment. The financial statements, the previous comparative period will be revised. The problem will come when there is a change in accounting estimate. It results in only the future prospective financial statements, not what has happened previously. Like, let's say in 2021, my bad debt provision was, because of COVID, it was 15%. But in 2022, the allowance for bad debt was reduced to just 3%. And it's quite a sizable charge compared to this. Since it's just simply a change of accounting estimate, I just cannot revise my last year's financial statements on 3 or this on 15. So in this case, as an analyst, this would be something that is a trouble because last year there is a massive charge on allowance and this year just 3%. So your net profit percentages, your operating profit percentages are no longer useful here. So here is, we need to find some way in order to make them comparable. They are no longer comparable because one contains a charge of 15, other 3%. So the numbers on profitability might be a little misleading. So that's a problem for me. So accounting estimates will only affect your future financial statements, affects the future period only. Prior year financial statements are not revised. Okay, Ms. Maham says, how many years? Miss, as many years as you have given. Let me show you. Let's say you have given the 5 years comparators. Let's say that's extreme situation. 2015, 2016, 2017, 2018, 2019, 2020, and 2021 was the year when the new financial reporting standard on revenue recognition was adopted and promulgated. Now, miss, you have to revise all these years. to make them comparable. Retrospective treatment means whatever you're reporting, you have to revise from the earliest, mind the word, the beautiful word, earliest reporting period. Which of these is the earliest? 2015. And that is a hell of a task, of course, that you're right. So you have to revise all these numbers so as to bring them on the same footings for comparison purposes. The law, the standard on US GAAP and IFRS, they are explicitly clear that you need to revise your financial statement from the earliest reporting period, whichever is the earliest. So your earliest could be 2015 or your earliest could be just 2019, depending upon what you've given. Exactly. So for us CMAs, we don't have to be worried. This is the domain of CPAs. But what if, Yusuf, you're working as a CFO in a firm or chief accounting officer, even if you are a CMA, then you will be in trouble. Then finally, if you discover an accounting error that occurred in 2020 and you are reporting your 2022 results, so you just can't let that error stay there. Accounting errors are retrospectively applied. You need to revise your prior year's financial statement so as to bring them on the equal basis for our financial statement analysis. So for us as a management accountant or as a financial analyst, change in accounting principle, if it happens, good for us, the numbers will be on similar basis. Retrospective treatment for accounting errors, this will be okay for us. But the problem will come when only prospective future years are affected, the prior years are not, then that would be the trouble for us for the comparison purposes. So this is the only area that you need to focus, what I've done previously also. Our focus should be from the financial statement analysis perspective, not how those numbers have been drawn up based upon different accounting standards, because that is the domain of your CMA Part 1, Section 8. Now, a change in estimate, accounting estimate for your provision for doubtful debts. Retrospective treatment means you made an error previous period. Maybe you charge $100,000 more depreciation in the last year because of some error, or inventory was undervalued or overvalued. So error means you made some accounting mistake that needs to be rectified. Accounting estimate, they change. They are not wrong or right. They are just, last year we charged 50% provision, this time is 3%. So estimates are different, errors are different. So guys, that ends your topic, factors affecting reported profitability. And I guess there are just 2 questions related to these. There are very few questions. Baldwin Corporation's inventory expressed as a percentage of current assets. Our inventory expressed as a percentage of current assets increased from 25% last year to 35% this year. Our inventory as a percentage of assets has increased from 25 to 35. The factor that is least likely to cause this difference, least likely. The question is, last year my inventory was 25% of current assets. This year my inventory is 35% of the current assets. Which of these is least likely justification for this difference? Let's move in the reverse order. Used a material amount of cash from selling its short-term investments to purchase land. When you utilize your short-term investment to purchase land, that means your current assets have fallen. When your current assets have fallen because of usage of cash and short-term investments, inventory now will become a larger proportion of your current asset. Now, let me explain the idea. It's a little difficult for you to interpret this way. Let's say my inventory is $10,000. Right? And my total current assets are $50,000. Okay. Now my inventory is, as you can see, 20% of my current assets. Right? What happened? I utilized some marketable securities and I sold them and I used the cash to purchase land, which means my current assets will now fall to, let's say, just 20,000 only. Right? Now your current assets are 20. Inventory is the same. Inventory now is what percentage of your current assets? It is now 50%. It's a very fine point. If you have utilized your current assets to purchase land, your current assets will fall in total and your inventory will be now a bigger percentage of it. So this is one of the valid explanations that you use your short-term investments, your current assets have fallen, inventory now is a larger percentage of your total current assets. That is the right valid option. C, the company has inventory that is becoming obsolete. Your inventory levels are swelling. You have not written off your inventory. So that is why your inventory is now in a higher percentage level. This is a valid justification also. B, the company is beginning to experience growth. Since your business is growing, you are now keeping more stock with you. And that is why your stock has swelled from 25% to 35%. This is a valid justification why your inventory level has jumped from 25 to 35. What about A? A says the business is seasonal business with traditionally high activity in summer months. Since the business is seasonal in nature, you always end up at July, and in July every year the inventory activity level is more. So this is not something unexpected. Every time, every year, there is the same effect of seasonality. So this is not something that has happened suddenly. Last July it was 25%, this July is 35%. So this doesn't justify, because the seasonality is there. If seasonality is there, July last year was the same as July this year. Why do we have more inventory than the last year? This is not the cause. This is not the reason, because of seasonality. Because season of July comes every year, not this year alone. Last question. Which of the following ratios would be most affected by the miscellaneous or the non-recurring income? Non-recurring income, consider your gain on disposal of long-lived assets. You sold your assets at a gain, and you don't do that every year, or you don't do it every month. So it is a non-recurring income, because disposal gain is not something that repeatedly happens. So if there is a non-recurring income or some miscellaneous item, which of these will be affected? Let us move in the reverse order. Debt to equity ratio. Debt to equity has nothing to do with your non-recurring income. It is not affected. Gross profit percentage. This profit is calculated before any non-recurring income or other losses. So this is again not affected. Operating profit, again, it is calculated before any unusual non-recurring items. What will be affected is the net profit margin, because net profit is calculated after, yes, Vivek, you're absolutely right, Vikas, after miscellaneous or other non-recurring income. So that makes A to be the correct option.